Question 1. A registered representative receives an order from a customer to purchase shares of a specific mutual fund. The representative notes that the customer has never received a prospectus for this fund. When must the customer receive the fund's prospectus? A. At or before the time of the sale confirmation. B. At or before the time the trade is executed. C. Within 3 business days of the order execution. D. Prior to the representative soliciting the order. Answer: A. At or before the time of the sale confirmation. The Securities Act of 1933 requires that a mutual fund prospectus be delivered to a potential investor at or before the completion of the sale, which is represented by the sale confirmation. This rule ensures the investor has access to all material information, such as the fund's objectives, risks, and fees, before the transaction is finalized. While a prospectus is typically delivered before or during the solicitation phase, the mandatory regulatory deadline is tied to the confirmation. Remember that the prospectus is the primary disclosure document and must be provided before the customer is truly obligated to pay. Question 2. Under FINRA Rule 2210 regarding communications with the public, which of the following communications must be approved by a registered principal prior to first use? A. Correspondence sent to a single customer. B. Retail communication concerning investment company shares. C. Institutional communication sent to an insurance company. D. An independently prepared reprint used to educate customers. Answer: B. Retail communication concerning investment company shares. Retail communication, defined as any written or electronic communication distributed to more than 25 retail investors within any 30 calendar day period, requires principal approval before it can be used. This rule applies to communications regarding mutual funds and variable products, as they are considered investment company shares. Correspondence sent to 25 or fewer retail investors and institutional communication are generally subject to review but do not require pre-approval. Always ensure that any broadly distributed sales material, the primary target of this rule, is signed off by a supervisor first. Question 3. A registered representative recommends a customer switch from one family of funds to another, which involves the liquidation of their current holdings and the purchase of new funds with similar investment objectives and a new sales load. This action is most likely a violation of which FINRA rule? A. Trade confirmation rule. B. Breakpoint rule. C. Suitability rule. D. Anti-money laundering rule. Answer: C. Suitability rule. Recommending a switch from one mutual fund to another with similar objectives, especially when a new sales charge load is incurred, is an action known as switching or churning, and constitutes an unsuitable recommendation. The core concept being violated is the obligation to have a reasonable basis to believe the recommendation is beneficial for the customer, considering that the additional sales charge offers no real benefit. The key clue is the similarity in objectives combined with the new load, which indicates the primary motive was to generate a commission rather than improve the customer's portfolio. Remember that recommendations must always be customer-centric, not commission-centric. Question 4. All of the following are generally tax-exempt to the investor at the federal level except: A. Interest received from a municipal bond fund. B. Interest received from a single municipal bond. C. Capital gains distributions from a municipal bond fund. D. Income from a municipal fund security used for college savings. Answer: C. Capital gains distributions from a municipal bond fund. While the interest income generated by a municipal bond or passed through a municipal bond fund is generally exempt from federal income tax, capital gains distributions are always taxable. Capital gains occur when the fund sells a bond for more than its purchase price, and these distributions retain their character as taxable income when passed through to the investor. This is an important distinction to make because it affects the overall after-tax return for the investor. Do not confuse the tax treatment of tax-free interest with the always taxable nature of capital gains. Question 5. The purchase price for a mutual fund share that includes a sales load is called the A. Net asset value, NAV. B. Public offering price, POP. C. Ask price. D. Bid price. Answer: B. Public offering price, POP. The public offering price, POP, is the amount an investor pays to buy a share of a mutual fund and represents the fund's net asset value, NAV, plus any applicable sales charge or load. This price is essentially the ask price for an open-end investment company. The NAV is the liquidation value of a single share, calculated as the fund's total assets minus liabilities, divided by the number of shares outstanding. Here's an easy way to remember. The public offering price is the price offered to the public, which includes the sales commission. Question 6. An investor makes an initial purchase of a mutual fund with a $4,000 investment. After 1 year, they purchase an additional $3,000 worth of shares, and then 2 months later they invest $4,000 more. If the mutual fund offers a breakpoint at $10,000, which feature allows the investor to aggregate these purchases to qualify for a lower sales charge? A. Rights of accumulation, ROA. B. Letter of intent, LOI. C. Breakpoint sale exemption. D. Dollar cost averaging. Answer: A. Rights of accumulation, ROA. Rights of accumulation, ROA, allow an investor to qualify for a reduced sales charge, a breakpoint, by aggregating the current market value of previously purchased shares with any new purchases. The customer in this scenario has already invested $7,000 and is now adding $4,000, totaling $11,000, which exceeds the $10,000 breakpoint. A letter of intent, LOI, by contrast, is a non-binding agreement to invest a specified sum over a 13-month period to immediately qualify for a reduced sales charge on the current purchase. Always remember that ROA uses the current market value of past holdings, while an LOI is a promise for future investments. Question 7. Which of the following statements is true regarding a variable annuities accumulation unit? A. Its value remains constant during the payout phase. B. Its value fluctuates based on the performance of the separate account. C. It is directly tied to the performance of the insurance company's general account. D. The number of units decreases as the annuitant ages. Answer: B. Its value fluctuates based on the performance of the separate account. During the accumulation phase of a variable annuity, the investor contributes payments used to purchase accumulation units, and the value of these units fluctuates daily based on the investment performance of the underlying separate account portfolio. The number of accumulation units remains constant unless the investor adds or withdraws money, but their value changes with the market. Once the annuity is annuitized, switches to the payout phase, accumulation units are converted into annuity units, which then determine the monthly payment amount. Keep in mind that the separate account is where the customer assumes the investment risk. Question 8. The proceeds from a mutual fund redemption must be sent to the customer within how many days of the redemption request? A. 1 business day. B. 3 business days. C. 5 business days. D. 7 calendar days. Answer: D. 7 calendar days. The Investment Company Act of 1940 mandates that mutual funds must pay redemption proceeds to investors within a maximum of 7 calendar days following the receipt of a proper redemption request. This is often described on the exam as T+7, trade date plus 7 calendar days. Although most funds process redemptions much faster, typically on the next business day, T+1, the regulatory limit is 7 days. Understand that the redemption price is based on the next net asset value, NAV, calculated after the request is received, a practice known as forward pricing. Question 9. An individual is seeking a securities license and has been arrested for a crime related to the manipulation of municipal bond prices 4 years ago, though they were acquitted. Which party is responsible for investigating this background information and determining eligibility? A. The Securities and Exchange Commission, SEC. B. The Financial Industry Regulatory Authority, FINRA. C. The Municipal Securities Rulemaking Board, MSRB. D. The State Securities Administrator, Blue Sky. Answer: B. The Financial Industry Regulatory Authority, FINRA. As the self-regulatory organization, SRO, responsible for overseeing broker-dealers and registered representatives, FINRA is primarily responsible for investigating the background and determining the statutory disqualification status and eligibility of an applicant. FINRA reviews the U4 application, which requires disclosure of specific criminal and regulatory events, regardless of the final outcome, like an acquittal. Even non-final matters or arrests must be disclosed on the U4 form so FINRA can assess whether the individual meets the standards of a qualified associated person. Question 10. When an investor liquidates an investment company share, The price received is based on the fund's A. Public offering price (POP) at the time of the order. B. Net asset value (NAV) calculated at the close of business that day, less any redemption fee. C. Closing market price on the exchange, plus any sales charge. D. Highest price traded during the previous business day. Answer B. Net asset value (NAV) calculated at the close of business that day, less any redemption fee. Mutual fund shares are priced using the concept of forward pricing, meaning the price received upon redemption is the next net asset value (NAV) that is calculated after the redemption request is received. The NAV is typically calculated once per day at the close of the New York Stock Exchange, 4 p.m. Eastern Standard Time. The actual amount received is the NAV less any contingent deferred sales charge (CDSC) or redemption fee. The key concept here is that all purchase and redemption orders must receive the next calculated price, not the one that was available when the order was placed. Question 11. Which of the following investment vehicles trades on an exchange or over-the-counter and can be purchased on margin? A. Open-end investment company, mutual fund. B. Variable annuity separate account. C. Closed-end investment company. D. Unit investment trust, UIT. Answer C. Closed-end investment company. Unlike open-end mutual funds, which are continuously issued and redeemed by the fund at their NAV, closed-end investment companies issue a fixed number of shares only once, and those shares then trade in the secondary market on an exchange or OTC. Because they trade in the secondary market like common stock, closed-end fund shares can be purchased on margin. Open-end mutual funds and variable annuities are continuous primary offerings and cannot be bought on margin. Question 12. A customer invests $2,000 into a Roth IRA. Which of the following statements concerning this investment is correct? A. The contribution is tax deductible. B. Qualified distributions are tax-free. C. Withdrawals of earnings are taxed as ordinary income. D. The customer must be at least 59.5 to contribute. Answer B. Qualified distributions are tax-free. The defining characteristic of a Roth IRA is that contributions are made with after-tax dollars, meaning they are not tax-deductible, but all qualified withdrawals of both contributions and earnings are entirely tax-free. For a withdrawal to be qualified, the account owner must be at least 59.5 years old and the account must have been established for at least 5 years. This structure is a key difference from a traditional IRA, where contributions may be deductible and withdrawals are taxed as ordinary income. Question 13. Which of the following is an investment company that issues redeemable shares and does not charge a sales load? A front-end load fund. B. A 12b1 fund. C. A no-load fund. D. A Class B share fund. Answer C. A no-load fund. A no-load fund is a mutual fund, an open-end investment company, that sells its shares directly to the public at the net asset value, NAV, and does not impose a sales charge or commission. While no-load funds do not charge a front-end sales load, they often impose fees such as administrative fees and 12b1 fees to cover marketing and distribution costs. The key word no-load means there is no sales commission added to the NAV to create a public offering price. Question 14. Which document is used to report disciplinary actions, customer complaints, or statutory disqualification events concerning an associated person? A. Form U4. B. Form U5. C. Form BD. D. Form U6. Answer D. Form U6. Form U6 is the Uniform Disciplinary Action Reporting Form used by SROs, such as FINRA and state regulators to report disciplinary actions against a firm or an associated person, as well as to report final arbitration awards involving customers. By contrast, Form U4 is the initial registration application, and Form U5 is used to terminate a registration. Remember that the Form U6 is the mechanism for reporting bad news like regulatory actions and customer arbitration results to the Central Registration Depository, CRD, system. Question 15. The investment objective of a money market fund is to A. Provide long-term capital appreciation. B. Seek a high level of tax-exempt income. C. Maximize current income while maintaining liquidity and capital preservation. D. Offer diversification by investing in common and preferred stocks. Answer: C. Maximize current income while maintaining liquidity and capital preservation. Money market funds are designed to be extremely safe, highly liquid investment vehicles that invest in short-term debt instruments, such as U.S. Treasury bills and commercial paper. Their primary objectives are to maintain a stable net asset value, NAV, typically fixed at $1 per share, and provide investors with current income and immediate access to their capital. The key concept is their focus on capital preservation and liquidity, making them a popular cash management tool. Question 16. The provision of a variable life insurance policy that allows the policyholder to cancel the policy for a full refund of premiums paid, typically within a short period after issuance, is known as the annuity period. B. Investment clause. C. Free look provision. D. Non-forfeiture option. Answer: C. Free look provision. The free look provision is an insurance requirement that allows a new policyholder a specific period, typically 10 days for regular insurance or often longer, e.g. 45 days, for variable life policies, to examine the contract and return it for a full refund of all premiums paid. This ensures that the customer has time to review the complex details of the policy, including its investment risks, without being financially committed. The key takeaway is that this provision acts as a consumer protection mechanism to rescind the contract after delivery. Question 17. The maximum front-end sales charge permitted under FINRA rules for an open-end investment company, mutual fund, is A. 8.5% of the offering price. B. 7.25% of the offering price. C. 6.25% of the offering price. D. 5% of the offering price. Answer: A. 8.5% of the offering price. FINRA rules permit a maximum sales charge of 8.5% of the public offering price (POP) for mutual funds. However, to charge the full 8.5%, the fund must also offer three specific features to investors: rights of accumulation, breakpoints, and reinvestment of dividends at NAV. If a fund does not offer all three, the maximum sales charge is significantly lower. Remember that the maximum load is a regulatory protection designed to ensure that excessive commissions do not erode investor returns. Question 18. Which of the following is not required for a member firm to transmit a mutual fund order? A. The customer's written instruction for the trade. B. The customer's full name and address. C. The customer's account number. D. The representative's identifying number. Answer: A. The customer's written instruction for the trade. A mutual fund order, like most securities orders, can be transmitted to the broker-dealer as a verbal instruction from the customer. Written instructions are not a mandatory requirement for order entry. However, the firm must have all the essential account information, including the customer's full name, account number, and the registered representative's identity, to accurately and properly execute and record the transaction. The most important takeaway is that verbal communication is sufficient to enter a trade, but the member firm must maintain an auditable record of the order. Question 19. A registered representative is assisting a customer with their tax-advantaged retirement savings. The customer works for a public school system. Which retirement plan should the representative recommend? Traditional IRA. B. Roth IRA. C. 401k plan. D. 403b plan. Answer: D. 403b plan. The 403b plan, often called a tax-sheltered annuity (TSA), is the specific retirement plan available to employees of public educational institutions, such as the public school system described, and certain nonprofit organizations. This plan allows employees to make pre-tax contributions through salary reduction, similar to a 401k, and is typically invested in either annuity contracts or mutual funds. The specific employer type is the key clue, as 401k plans are generally available to employees of for-profit companies. Question 20. When determining whether a variable annuity is suitable for a customer, all of the following factors must be considered except: A. The customer's existing insurance coverage. B. The customer's net worth and annual income. C. The customer's tax status, including whether they have fully funded other retirement accounts. D. The performance of the separate account over the last 12 months. Answer: D. The performance of the separate account over the last 12 months. The suitability determination for a variable annuity must focus on the customer's financial situation, tax status, investment objectives, and need for insurance, not the recent performance of the separate account. Short-term performance is highly speculative and is not a determinant of the long-term appropriateness of the contract structure itself. Since a variable annuity is a long-term retirement planning vehicle with potential surrender charges, a representative must prioritize the customer's need for the income stream, their ability to sustain long-term commitment, and their risk tolerance. Question 21. Which statement is true regarding the taxation of a non-qualified variable annuity during the accumulation phase? A. All earnings are tax-exempt until withdrawal. B. All earnings are taxed annually as capital gains. C. Investment income and capital gains are tax-deferred. D. Contributions are tax-deductible but earnings are taxed. Answer: C. Investment income and capital gains are tax-deferred. A non-qualified variable annuity is funded with after-tax dollars, meaning contributions are not tax-deductible, but all earnings generated within the separate account grow on a tax-deferred basis. Tax deferral means the investor does not pay taxes on the income or capital gains until they make a withdrawal, which is usually during retirement. The important concept is that the separate account shields the investment growth from current taxation. Question 22. Which entity is responsible for safeguarding the assets and maintaining the administrative records of a mutual fund? A. The transfer agent. B. The investment advisor. C. The custodian. D. The distributor. Answer: C. The custodian. The custodian is typically a commercial bank responsible for holding the fund's securities and cash in safekeeping, collecting dividend and interest payments, and acting as the intermediary for all portfolio trades. By contrast, the transfer agent maintains the record of shareholder names and addresses, and the investment advisor manages the portfolio. The crucial role of the custodian is to physically safeguard the fund's assets to ensure shareholder protection. Question 23. A registered representative who receives a written customer complaint must take which of the following actions? A. Resolve the complaint immediately without notifying the firm. B. Forward the complaint to a principal for review. C. File the complaint with FINRA directly. D. Notify the customer that only written complaints will be handled. Answer: B. Forward the complaint to a principal for review. When a registered representative receives a written customer complaint, they are required to immediately forward the complaint to their supervising principal. The member firm is then responsible for reviewing the complaint, responding to the customer, and reporting the complaint to FINRA in accordance with regulatory guidelines. It is against compliance policy for a representative to attempt to handle or resolve a written complaint independently. Question 24. An investor buys a mutual fund share at an NAV of $10 and receives a dividend distribution of 50 cents. The next day, the investor sells the share at an NAV of $10.20. What is the investor's gain from the sale of the share? A. 70 cents. B. 20 cents. C. $0. D. 50 cents. Answer: B. 20 cents. The investor's gain from the sale of the mutual fund share is calculated based only on the change in the share's net asset value, NAV, between the purchase and the sale. Since the investor bought at $10 and sold at $10.20, the capital gain is 20 cents. The 50 cents dividend distribution received is treated as separate investment income, and importantly, the NAV of the fund is reduced by the amount of the dividend on the ex-dividend date, so the distribution does not count toward the capital gain on the sale of the share. Question 25. Which characteristic is unique to an open-end investment company, mutual fund, compared to a closed-end investment company? A. Shares trade in the secondary market. B. Shares are redeemable by the issuer. C. The management fee is based on the assets under management. D. The portfolio is managed by an investment advisor. Answer: B. Shares are redeemable by the issuer. Open-end investment companies or mutual funds are unique because their shares are continuously issued and redeemed by the fund itself, making them a redeemable security. This key feature means that the number of outstanding shares constantly changes, and the fund must always be ready to buy back shares at the net asset value, NAV. In contrast, closed-end funds have a fixed number of shares that trade between investors in the secondary market, making them non-redeemable securities. Question 26. Which of the following is an example of an unethical practice known as selling dividend? A. Recommending a bond fund to an investor whose objective is capital appreciation. B. Encouraging a customer to purchase a mutual fund share just before the ex-dividend date to receive a distribution. C. Selling a customer's shares right before the record date to avoid an imminent capital gains distribution. D. Failing to inform a customer about available breakpoints on a mutual fund purchase. Answer: B. Encouraging a customer to purchase a mutual fund share just before the ex-dividend date to receive a distribution. Selling dividend is the unethical practice of encouraging an investor to buy a mutual fund just before the ex-dividend date to capture an imminent dividend distribution. This is misleading because the share price is reduced by the amount of the distribution on the ex-dividend date, and the distribution is immediately taxable to the investor. The net result for the investor is usually negative, as they receive no economic benefit but incur a tax liability. This practice is a violation of the firm's obligation to deal fairly with customers. Question 27. Under FINRA rules, what is the maximum value of a gift an associated person may give to any one person per year in connection with their business? $50. B. $100. C. $250. D. $500. Answer: B. $100. FINRA rules on gifts and gratuities state that an associated person may not give any gift that exceeds $100 in value per person per year in relation to their business activities. This rule is designed to prevent unfair business practices and the undue influence of brokers on clients or employees of other firms. The $100 limit is a firm, non-negotiable ceiling, even when split between spouses. Remember this simple dollar limit to avoid violating the rules of conduct. Question 28. If an investor signs a letter of intent, LOI, to qualify for a breakpoint on a mutual fund purchase, how long is the agreement generally valid? 6 months. B. 13 months. C. 18 months. D. Indefinitely. Answer: B. 13 months. A letter of intent, LOI, is a non-binding agreement that allows a mutual fund investor to immediately qualify for a lower sales charge based on a promise to invest a certain amount within a specified future period, which is typically 13 months. The LOI can be backdated up to 90 days, which effectively allows the investor to aggregate purchases over a maximum of 15 months. The key time period for the life of the agreement, however, is the standard 13 months. Question 29. A customer holds shares in a mutual fund and receives an annual distribution that consists of long-term capital gains. How will this distribution be taxed to the investor? A. As ordinary income. B. At the investor's long-term capital gains rate. C. As a tax-exempt dividend. D. As a return of capital. Answer: B. At the investor's long-term capital gains rate. Under the conduit theory of taxation for investment companies, capital gains realized by the fund and distributed to shareholders retain their character. Therefore, long-term capital gains distributions from a mutual fund are taxed to the investor at the typically lower long-term capital gains rate, regardless of how long the investor has held the fund's shares. This is a crucial concept because it means the fund acts as a pass-through entity for the tax nature of the income. Always be sure to distinguish between ordinary income dividends, which are taxed at higher rates, and long-term capital gains distributions. Question 30. Which of the following best describes the difference in liquidity between a mutual fund and a variable life insurance policy? A. Both are considered highly liquid and can be redeemed without penalty. B. A mutual fund is illiquid while a variable life policy is highly liquid. C. A mutual fund is highly liquid, while a variable life policy may incur surrender charges or affect the death benefit upon withdrawal. D. Withdrawals from both are subject to a 10% penalty if the owner is under age 59 and a half. Answer: C. A mutual fund is highly liquid, while a variable life policy may incur surrender charges or affect the death benefit upon withdrawal. Mutual fund shares are generally considered highly liquid because they are redeemable by the fund daily at the current net asset value, NAV, and the fund must pay within 7 calendar days. A variable life insurance policy, while offering access to the cash value, is less liquid because withdrawals may be subject to substantial surrender charges during the early years, and withdrawing the cash value reduces the policy's death benefit. Understanding liquidity differences is crucial for determining suitability, especially when comparing investment vehicles. Question 31. An associated person must complete a firm element of continuing education (CE) How often? A. Annually. B. Every 2 years. C. Every 3 years. D. Within 120 days of their second registration anniversary. Answer A. Annually. The firm element of continuing education, CE, requires member firms to prepare and implement an annual training plan to keep their associated persons informed of product changes, new regulations, and firm procedures relevant to their business activities. This training is specific to the firm and its products. This requirement contrasts with the regulatory element, which is administered by FINRA and must be completed by an associated person on their second anniversary and every 3 years thereafter. Question 32. All of the following are examples of management investment companies except a mutual fund, B. a closed-end fund, C. a unit investment trust UIT, D. an exchange-traded fund ETF. Answer C. A unit investment trust UIT. A unit investment trust UIT is classified as an investment company but is a non-managed portfolio because the trust is established with a fixed portfolio of securities that are held until a specific termination date. Management investment companies, which include mutual funds, open-end, and closed-end funds, are actively managed by a professional investment advisor who buys and sells securities within the portfolio to meet the fund's stated objective. The key difference is the fixed, passive nature of the UIT versus the actively managed structure of a mutual or closed-end fund. Question 33. A variable annuity contract has a death benefit provision. If the annuitant dies during the accumulation phase, the beneficiary will receive A. the greater of the cash value or the total premiums paid, minus any withdrawals. B. only the total premiums paid regardless of the separate account's performance. C. the cash value which is subject to probate. D. the total annuity unit value at the time of death. Answer A. the greater of the cash value or the total premiums paid, minus any withdrawals. The death benefit feature of a variable annuity acts as an insurance guarantee, ensuring that if the annuitant dies during the accumulation period, the beneficiary will receive at least the greater of the cash value, the current market value of the separate account, or the total contributions made, minus any prior withdrawals. This provision prevents the investor from losing their principal due to poor market performance. The death benefit is usually paid directly to the named beneficiary and generally avoids probate. Question 34. What is the required minimum principal approval process for the opening of a new customer account? A. Registered representative must interview the customer, but principal approval is not needed until the first trade is executed. B. The customer must sign the new account form, and the branch manager must review and approve it prior to the first trade. C. The new account form must be signed by the customer and approved by a principal promptly after the first transaction. D. The customer must provide written approval for all trades, and the principal must approve the new account within 7 business days. Answer C. The new account form must be signed by the customer and approved by a principal promptly after the first transaction. FINRA rules require a principal to review and approve the new account form promptly after the initial transaction, although the account form must be dated and signed by the customer before the first trade. For investment company products like mutual funds, the principal's signature on the new account form is a necessary step to officially open the account and signify due diligence. The key word promptly is used because immediate pre-approval for the very first trade is not always necessary, but the final account approval must follow quickly. Question 35. A registered representative sells a variable annuity and explains the investment options using a hypothetical illustration showing returns of 12%, 8%, and 0%. According to FINRA rules, what must the illustration also show? A. A required illustration of a gross return of 20%. B. A required illustration of a gross return of 10%. C. A required illustration showing a gross return of 0%. D. A required illustration showing a gross return of -2%. Answer D. A required illustration showing a gross return of -2%. FINRA rules on variable annuity illustrations require that if a hypothetical illustration showing an assumed rate of return is used, it must also include a second, more conservative illustration showing a 0% gross rate of return, and a third illustration reflecting the maximum mortality and expense, M&E, charge plus the maximum administrative charge applied to a negative return. often shown as -2%. This conservative projection is mandatory to demonstrate the potential for loss and is designed to manage customer expectations. The core concept is that sales literature must not mislead, and this low return scenario helps manage the perception of guaranteed returns.